Hello dear students, welcome to the fifth session on the chapter Retirement of a Partner. In this session, let us take up one more question. The following is the balance sheet of M, N and O as at 31st/12/2006. The partners shared the profits and losses in the proportion to their capitals. On the asset side, we find goodwill, building, stock, datas and bank balance. On the liability side, creditors, reserve fund, capitals of M, N and O. N wishes to retire from the firm on 1/1/2007. The following revaluation of assets are made. Goodwill at 10,000, buildings at 12,000, stock at 19,200, a provision of 10% to be created on debtors. Prepare partners capital account and new balance sheet. The amount due to retiring partner should be treated as loan. So in this question, just like the previous questions, we have to provide for some working note. Coming to the first working note, that is with regard to calculation of gain ratio, because here they have given the adjustment with regard to goodwill. Now, which case is applicable with regard to calculation of gain ratio? Here it is stated that the partners shared the profits and losses in the proportion to their capitals. The capitals of three partners M, N, O is given as 16,000, 8,000 and 8,000. So we have to take the ratio between 16,000, 8,000 and 8,000, which comes to 2:1:1. Okay, 2:1:1 is the old profit sharing ratio. Here 2 belongs to M, 1 belongs to N and the remaining 1 share belongs to O. So now here among the three partners, N is retiring. So they have given in this question only old profit sharing ratio. So which means that case 2 is applicable. So what case 2 says? The remaining or the new profit sharing ratio between the remaining partner itself is going to be the gain ratio. So if among the three partners, that is M, N, O, if N is retiring, who are the remaining partners? M and O are the remaining partners and their new profit sharing ratio would be 2:1. That is 2 and this 1. Okay, 2:1 is going to be the new profit sharing ratio, and as per case 2, the gain ratio is equal to new profit sharing ratio, that is 2:1. So this is regarding the first working note. As per case 2, we are calculating what is the gain ratio. Then coming to the second working note, that is with regard to goodwill treatment. In this question, the goodwill is given in the balance sheet and also they have given the revaluation value. Okay, so here if you see the asset side, goodwill is given at a book value of 8,000. What is the treatment required here? Whatever the existing goodwill is there given in the balance sheet, that has to be written off to all partners capital account including the retiring partner in the old profit sharing ratio, because that was the goodwill created even when the retiring partner was there in the firm. So it should be written off to all partners capital account in the old profit sharing ratio. Okay, that is the first adjustment required. So the entry would be all partners capital account data to goodwill account, and this 8,000 will be written off in 2:1:1 ratio. Then what is the other goodwill adjustment required? Here it is given that the goodwill is revalued at 10,000, but we are not going to show the adjustment with regard to 10,000. We are going to take only retiring partner's share in the revalued figure. So what is retiring partner share here? If we take 2:1:1, his share is 1/4. So we have to calculate what is his share in the revalued figure. So 10,000 into 1/4, okay, which comes to 2,500. So only with regard to 2,500 out of this 10,000, we are going to show the goodwill adjustment. And what is the goodwill adjustment required here? Remaining partners capital account data to retiring partners capital account, and this distribution should be done in the gain ratio, because the remaining partners have to give compensation to the retiring partner on his retirement. So this distribution of 2,500 between the remaining partner M and O, it should be done in the gain ratio of 2:1. Okay, so this is the journal entry. Remaining partners capital account data M, that is M's capital account data 2,500 into 2/3, O's capital account data 2,500 into 1/3 to N's capital account 2,500. Let me show you these working notes. The first working note is with regard to gain ratio. Case 2 is applicable here. So here it is given that the partners are sharing the profits and losses in proportion to their capital. So we have calculated here 16,000 is to 8,000 is to 8,000, which is simplified as 2 is to 1 is to 1. N is retiring from the firm, so the new profit sharing ratio between the remaining partner M and O is 2 is to 1. So as per case 2, gain ratio is equal to new profit sharing ratio, that is 2 is to 1. So this is first working note. Then coming to the goodwill adjustment, again it is divided into two adjustment. The first one is with regard to the existing goodwill which is given in the balance sheet. It should be, that is 8,000 should be written off to all partner, that is old partners capital account in the old profit sharing ratio, that is 2 is to 1 is to 1. Then coming to the second adjustment, out of the total revalued figure, that is 10,000, we are showing the adjustment only with regard to retiring partner's share, that is 10,000 into 1 by 4, which comes to 2,500, and the adjustment entry is M's capital account data 2,500 into 2 by 3, and O's capital account data 2,500 into 1 by 3 to N's capital account 2,500. Okay, so these are the two working notes required. Then what is the requirement given in the question? We have to prepare the revaluation account, partners capital account, and balance sheet after N's retirement. Now with regard to revaluation, preparation of revaluation account, we have to show the effect of revaluation of assets and liabilities. Here it is given that the building is revalued at 12,000. Earlier the book value was 10,000. So there is increase in the value of building by 2,000, which is the revaluation profit we have to show in the credit side of the revaluation account. Then stock, now it is revalued at 19,200. Earlier the book value was 20,000. So there is decrease in the value of stock by 800 rupees, which is a revaluation loss. You have to debit that. Then a provision of 10% is to be created on debtors. The book value of debtors is 10,000. On that 10% which comes to 1,000. So we are creating a provision against an asset which is a revaluation loss. Okay. So these are the three adjustments which we are going to show in the revaluation account. Let's see how to prepare it. First adjustment is with regard to revaluation of building. It is a revaluation profit 12,000 minus 10,000, which comes to 2,000. Then coming to stock, 20,000 minus 19,200, 800, which is a loss. Then we are creating a provision against debtors on how much? 10,000. We are going to calculate 10%, which comes to 1,000. Okay. After this, we are going to close the revaluation account and find whether there is net profit or net loss. In this case, the total credit is more. We are writing the same total even in the debit side here. Then we are going to take the balancing figure. We get 2,500. So this represents net profit, which should be transferred to all partners capital account in the old profit sharing ratio, that is 2 is to 1 is to 1. M will get 100 rupees, N will get 50 rupees, and O will get 50 rupees. So this is regarding the revaluation account. Then the next requirement is to prepare the partners capital account. In the partners capital account, as usual, we have to write the opening capital balances as given in the question by balance brought down 16,000, 8,000 and 8,000. Then the next step is to write the reserve balance. So here we have reserve of 8,000, again which should be distributed among the partners in the old profit sharing ratio of 2 is to 1 is to 1. So by reserve account. Then we have to check if they have given the profit and loss account balance either on the asset side or on the liability side. They have not given. Then we have to transfer the revaluation result here. We have written the entry here, revaluation account data to partners capital account. So in the partners capital account, we have to write by revaluation account 100 rupees, 50 rupees and 50 rupees. Then the entry will be with regard to goodwill adjustment. So first goodwill adjustment, as I said, it should be written off to all partners capital account. The entries all partners capital account data to goodwill account. The existing goodwill given in the books is how much? It is one minute, let me check. It is 8,000. So it should be written off to all partners capital account. So in the 2 is to 1 is to 1 ratio. So 4,000, 2,000 and 2,000. Then the other goodwill adjustment required is remaining partners capital account data to retiring partners capital account. So here both the sides of transactions are relating to capital account. So we have to show both the sides of transaction. So in M and O's column, we have to let me show you here. By M's capital account and by O's capital account, who should be given the compensation? The retiring partner. So you're writing as by M's capital account, but you're writing the amount in the retiring partner's capital account. Similarly, by O's capital account, the amount will be written in N's column, because the O's column. The retiring partner's account should be credited because he is given the compensation. The other part of the transaction, you are going to write in the debit side to N's capital account. The amount will be written in the remaining partner's column. Okay. Then after writing all these adjustments, there are no other adjustment with regard to capital account. We are going to close the account of partners one by one. But here, since it is a case of retirement, first we need to close the account of the retiring partner. So total credit here we get is 12,550. The same total is written here. And when we deduct this writing off of goodwill, we will have a balance of 10,550. Here it is given in the question that the final settlement is to be treated as a loan. Okay, so N is giving or N is advancing loan to the firm. Nothing is paid at the time of his retirement, so that will be taken as the amount of loan which the retiring partner has advanced to the firm, which will be paid in future. So you have to transfer it to N's loan account. You can write in the bracket that final settlement balancing figure. Okay, now coming to the remaining partners M and O, similarly we have to close the accounts. So we will write the credit side total even in the debit side, and we will have balances of 14,433 and 7,217. So these balances represent closing capital balances. Okay, after this we are going to prepare the balance sheet. So you have to mention on the top balance sheet after retirement. Buildings, we have to write the revalued figure 12,000. Stock also revalued figure, you can mention 20,000 minus revaluation loss 800 rupees, so you can take the balance to the outer column. Then debtors also here 10,000 less provision against debtors, 1,000 is deducted, remaining balance to the outer column, and bank balance as it is we have to write. Then coming to the liability side, creditors, there is no adjustment, as it is we have to write. Then reserve fund, it is already distributed. Then coming to the other liability which is now coming into existence is retiring partner's loan. The final settlement made to the retiring partner 10,550 has been treated as the loan advanced by the retiring partner, so it will appear as a liability. Hence loan account 10,550. Then we have to write the closing capital balances of the remaining partners M and O. After this we are going to prepare the balance sheet. So you have to mention on the top balance sheet after retirement. Buildings, we have to write the revalued figure 12,000. Stock also revalued figure, you can mention 20,000 minus revaluation loss